Let's get more now on Greece and where it all leaves investors. Well, joining me now is Jeremy Beckwith, the Chief Investment Officer at Kleinwort Benson. Now, he's very concerned about the Greek debt crisis spreading to other parts of the Eurozone. Thank you so much for being with us, Jeremy. Now, first of all, you haven't bought into this auction. You don't actually own any Greek bonds. Yep. It was a success. You regret not buying any?
Not at all. We're quite long-term investors, and I would have thought buying 10-year Greek bonds is still a very risky proposition. I wouldn't be at all confident investors will get their money back in 10 years' time.
Because there's a possible risk of a default?
Yes, exactly.
Really?
Yeah.
Because I have not heard anyone actually say there is a possible risk of a default. They're all saying, well, yeah, it's not looking good. They may ask for money. Mm-hmm. But do you believe that it will have to opt out of the EMU or the Eurozone?
Well, Greece has been an independent country for 178 years, and for nearly half of those years, its government bonds have been in default. So it's a fair bet. And I think the pain that the Greek public are being asked to go through here will prove too much. They've passed the law in Parliament, which is terrific, but actually, will the public actually let that happen over the next few years? I think it's a very tough call. Now,
you have a pretty dire view, of course, of the situation in Greece. So what does it all mean for your European equities as a whole?
Well, I think Europe is sort of sleepwalking towards a sort of deflationary mindset, because obviously Greece is having to tighten its fiscal policy very dramatically. But the next people in line are the Portuguese and the Spanish and the Irish and even the French. And they're all watching what's happening, thinking, actually, that could be us. So they're all actually now seriously looking at how they can tighten their own fiscal policy going forward. So across the whole of the European single currency zone, you're seeing tightening fiscal policy at a time when already you've got the ECB beginning to tighten liquidity. And actually, you've got no growth coming through in Europe. So Europe is tightening policy just at the worst possible time. It seems bad.
So you think they should be waiting? You think that these exit plans, this tightening of the fiscal policies and liquidity will lead to, what, a double-dip recession?
Yeah, I think it's entirely possible that you'll see a double-dip recession in Europe, yes.
In the next couple of months?
Well, this year.
So it means you're underweight on European equities?
We're very underweight in European equities.
Across all sectors?
Yes.
Is there anything that you'd buy in Europe? I mean,
well, the big oil companies, the Totals and those sort of companies are big global companies, and they're reasonably valued on a world view.
Jeremy, in terms of how Greece can do and what the European Union can respond, how do you see this outcome coming up? Tricia yesterday, the president of the European Central Bank, saying, well, they shouldn't go to the IMF because the problem should be handled by Europe. Can they handle it?
Yes, Europe can handle it in terms of they have the money, they can give the money or lend the money or guarantee the money. It's a relatively small amount for the EU as a whole, so they can do it. They have things like the Maastricht Treaty getting in their way, which gives it the no bailout clause, so they're not supposed to just give it to Greece or lend it on advantageous terms. It has to be done at proper prices. So it's possible, it's complicated, but they want to. The point is that the Europeans don't want Greece to go to the IMF because it's a European problem. They want to solve it themselves.
All right, so if you think that, I mean, we're talking almost Armageddon. I know what you think about Europe. If we're looking at a double dip, fiscal tightening too soon, how low can the equities?
I'm getting to the end of the world. No, I'm just talking about not much growth for a few years.
But what kind of correction are we going to see on equities?
Well, 10, 15, 20% this year. It's possible.
And this is across the board in European equities.
Yeah.
So what would you be buying instead?
Well, we're not wonderfully optimistic on most equity markets, but the ones we're most happy with are Japan. I think for the next 3 to 6 months still looks a very interesting market. It's one of the markets that has the greatest export sensitivity to China, which is still growing very nicely. It's the cheapest developed market in the world by quite a long way on price to book and price to sales. And it's a market where everybody's underweight. And if there was any good news in Japan, I think you'd see Japanese equities actually rising in price quite sharply. So we like Japan. It's a trade for the next 3 to 6 months, I think.
What about the US?
US, we're neutral on the US equities. There's a lot of expectation built in for economic growth and for earnings growth this year. And I do struggle to see how companies there are going to beat those expectations. But the US does look like it's the part of the developed world is going to have the strongest growth this year. But it's already expected, I think, to a great extent.
We had some pretty good job figures. Does that give you hope that it will actually recover sooner than expected?
Well, the job figures were a bit better than expected, but they still showed loss of jobs. So, you know, we're still in the employment market, still in recession. People are still losing their jobs in the US. So they're good because they're better than expected, but they're not terrific numbers.
So in terms of what you would invest in the US, if anything, again, the oil companies or commodities?
Well, yeah, we would invest in those companies where the top line is relatively secure and defensive, and where ideally there's exposure to the Asian economies, because that's the part of the world you're going to see the strongest economic growth, and that's the safest part of the world to find growth investments, I think, going forward.
All right, Jeremy, thank you so much. Jeremy Beckwith there. And